Hi, and thanks for joining us for another episode of Ask Spurrell CPA. Today we're talking about understanding your profit and loss statement. I'm here with Laura. Laura, thanks for joining me here today. Laura, you're looking forward to your first personal tax season?
Yeah, can't wait.
Okay, so any particular projects you're looking excited to work on? Or?
I'm looking forward to doing some rental property.
Okay, I'm sure we'll have some clients with some rental properties for to work on. So the quote today, understanding your profit and loss, that we want to bring to you is by Warren Buffett. Accounting is a language of business. Of course, we're really committed that, the statistic we always bring up is 50% of all Canadian small business fail. And, one of the three main reasons of why that happens, they run out of cash. So understanding your profit and loss statement is important to, prevent that. And the story is that, we get business owners and they're making important decisions based on these profit and loss statements that they're either incorrect or they don't really understand the profit and loss statement. So, Laura, what do you think are the questions that these business owners they should be asking?
Why should you look at the balance sheet before the income statement?
So this is, we have a whole other video on this one as well, but, a lot of times there's obvious errors in the income statement that if you had looked at the balance sheet to compare to monthly balance sheet first, you would have seen it. So if you just pick up the income statement, you're taking a big risk, especially with interim statements are not subjected to the same, process and quality assurance process that year-end statements are. So you want to look at that balance sheet first and have some comfort with it, because it gives you more, certainty that profit and loss statement that you're making significant business decisions on is correct.
How does looking at a 6-month comparative profit and loss statement help?
So we always, suggest when reviewing these interim statements that we're looking at a 6-month comparative, and for a couple of reasons. Number one, it's going to give you some comfort that the information is correct and reliable, because if we're looking at 6 months, you can see, any anomalies in terms of variations from month to month. Maybe the revenue is way different, or, we have a utility bill and it's completely different than it was in every other month. If you just look at 1 month, those errors are a little bit difficult to determine. But if you're looking at 6 months, usually those errors become really clear really quickly. So, I encourage people to look at that 6-month comparative. Probably the second reason is maybe there's no misstatement at all, but there's really something different that's occurred in that month. We didn't incur this expense that we normally incurred, or we have a one-time expense. So maybe the net income doesn't look so good, but, next month's expected to be pretty good because we have this one-time expense that's not going to occur. So those 6-month comparative, I normally view that's the threshold. You can usually get that on one screenshot, and people can do some really quick and really powerful analysis based on that 6-month comparative.
How can having too many income statement accounts be counterproductive?
Yeah, and this is a real common one. People think that they should have an income statement account for everything. You want to boil down your income statement to a one-page item. That's not to say that you can't have sub-accounts, or you can't run filter reports based on items to get more specific when need be. But that needs to wind up into a one-page report at the end of the day, because that one page should be your powerful decision maker in guiding your decisions. If it's too long, it becomes an unnecessarily complex task. We have giant public companies, and they have a lot of detail that goes into their profit and loss, and a lot of sub-accounts and a lot of classifications in the background. But at the end of the day, they wind giant public company income statements and profit and loss statements into one page. And if you can't, and there's a reason why, is because that becomes a powerful decision-making tool. And if you can't do it, it's not great. Also, it tends to be when you have all these different sub-accounts that your classification is incorrect. Let's say you have a utility bill, and 1 month you declare it as a phone bill, and the next month you declare it as utility. The next month you declare it as cell phone. You look at the comparative from month to month, and it looks like I'm saving money or I'm spending more money in that, but really nothing's changed. It's just the way you've classified it has changed. So when you're trying to compare historical, variances, the analysis can be off, depending on how many sub-accounts you have, because the more accounts you have, the more difficult it is to be consistent in the classification.
Why should you review your income statement in numerically descending order?
Yeah, so usually income statements are either organized, you always have the revenue up top, the cost of sales next, and the general expenses. But in those general expenses, or even the cost of sales, you can do alphabetically or numerically descending. Neither are wrong, but I just think numerically descending, draws your attention to what you need to do. Because in most businesses, you have your revenue, you have your cost of sales, And then the general expenses that you have, normally you have a cost for administrative staff, you have a cost for rent, and a lot of other businesses, all of the other overhead expenses, they don't make they don't amount to a pile of beans, as I've heard someone say, in terms of if you're going to make money or not. Even if you were able to eliminate all of your other overhead costs by 50%, if you can't do anything about that staffing payroll problem, or if you can't generate more revenue, or if your space costs too much, you're never going to make any money. So it draws your attention to the most significant items up top, so you know how to allocate your time as a business owner. These will make the biggest difference on my bottom line, and the ones down here, they'll make a little bit of a difference, but not as much. So that's why I think they're important. Let's organize it in order of importance.
What is the difference between direct costs and general expenses?
So the direct costs, these are normally costs that are only incurred as a result of doing the work. So let's say you're a contractor, for example. These are the costs of the sub-trades on the job and the materials on the job. So if you didn't have this job, these wouldn't have occurred. They're directly related to that job, and if that job didn't exist, these costs wouldn't exist. Let's say, give you another example. If you're a dentist and you have an associate doctor and you have some hygienist, and let's say you only pay that associate doctor based on a percentage of their billings, that is a direct cost. That cost would not exist if they didn't have that revenue. As opposed to the general costs, these are generally costs that they're overhead costs that you're probably going to have them whether the revenue occurred or not. They're an overhead cost of the business. So ones are going to vary. The direct costs are going to vary relative proportion to the revenue, where the overhead costs, a lot of times, they're going to stay relatively the same unless you make structural changes in your business or changes to your processes or setup. But it's not really the amount of revenue that's driving them.
Why is it important to consider the percentage of revenue when analyzing direct costs?
Yeah, so just because your direct costs went up in a month, that's not necessarily a bad thing. I mean, you did $5,000 or $10,000 of revenue one month, and the next month you do $20,000 of revenue. And you look at your direct costs, one month they're 5 and next month they're 10. It's not that your costs were out of control. In fact, that your direct costs were still 50% of your revenue. So we would expect them to go up, relatively in proportion to the revenue. So rather than, if you're analyzing how efficient your direct costs are, looking at the aggregate value can be very misleading, but looking at those direct costs as a percentage of the revenue, that's a very powerful number, and that'll tell you if we're being more or less efficient.
What's the difference between gross profit and net income?
So the gross profit that we have, and we're really just looking at the revenue less the direct costs. So we're not really taking into account the overhead of the business. We're just looking at what were the direct costs that it actually took to get the job, directly get that job done. And that's your gross profit. And then we have net income at the bottom is, what we make or what we lose, after we take those overhead costs into account.
Why does a negative number on the income statement often indicate a mistake?
So normally if you're looking at revenue, that's a positive number. You normally don't have negative revenue. Cost of sales, same thing. If we pay a supplier, we don't pay a supplier a negative amount. We pay them an actual amount. So normally if you're looking at your income statement and you see a negative amount, that should jump out to you. What really happened here? Was it some sort of timing error? And 9 times out of 10, it's probably a misclassification. Lots of times it's, the classifications are very similar where, let's say we bill for supplies and we also have an expense account that supplies, and that bill that, that went, the invoice to the client, we charged them for supplies, we posted it to the expense account, in which case it's going to show up as a negative number. So, whenever you're looking at your income statement, you see a negative number in a month-to-month comparison, you really got to know what that negative number is, because 9 times out of 10, it's a mistake.
Why is it important to separate the owner's salary from all other expenses?
Yeah, the owner's salary is generally a tax decision, and it's based more heavily on what's an efficient tax treatment, or it should be based on what's an efficient tax treatment for the owner's household, not as a factor of what they did, in the business. You want a way to separate the owner's salary from the activity of the business. And what we want to do is we want to boil down to a number on what does that business make before it pays the owner, and then what that business make after it pays the owner, because often that owner's salary has nothing to do with the business activity and everything to do with the owner's personal circumstances or a way to mitigate taxes. So you don't want to use that owner's salary when you're analyzing the performance and the effectiveness of the underlying business.
Why do asset purchases not belong on the profit and loss statement?
The asset purchase, is a timing principle. So what that means is, what we want to, the matching principle, sorry. And what that means is we want to match the expenses to the revenue. So we want to have the expenses that were used to generate that revenue match in the same period, where that revenue actually occurred. So if you go out and buy $100,000 piece of equipment that you're going to use for the next 10 years, you don't have a $100,000 expense in the month that you bought it. You have a $100,000 expense that should be depreciated or amortized over that 10-year period. They don't belong on the income statement because it's going to cloud what your performance on that month. It'll make that month look brutal, even though that month could have been your best month ever, and it just had a large capital purchase or equipment purchase, that a piece of equipment they're going to use for 10 years.
Should the principal portion of a loan payment appear on the income statement?
No, the principal portion of a loan payment should not appear on the income statement. The interest belongs on the profit and loss statement, but the principal portion should be on the balance sheet. So it should be reducing the loan balance over time. And it's important to know, is this business hamstrung by the value of the loan payments? If we were able to restructure those loans, get a longer amortization period, could we, correct this business? Or does the underlying business make no sense even if the corporation had no debt? That's the important part. So, they don't belong, principal portion of loan payments don't belong on the income statement, just the interest portion is an expense of the business.
Should you also review a year-to-date versus prior year profit and loss statement?
Yeah, so usually you're looking at your comparative monthly income statement, we call it, 6-month comparative balance sheet, 6-month comparative income statement, start there. Now, once you have some comfort on that month-to-month statement, which really points out the variances, where do we have any differences in performance or a possible misstatement, once we move past there, usually I'll encourage people to go to that year-to-date year-to-date income statement. So what you've made, and let's say you have a December year end, and now we're in March, and we're looking at, what happened in January, February this year versus what happened in January, February last year. Because just looking at the last 2 months can sometimes ignore, a lot of businesses have some seasonality. They have busy seasons, they have slow seasons. So what did this year look like to the same season last year? Now we start to get a real good roadmap on what the performance of our business is that we wouldn't necessarily get if we were just looking at, January and February next to November and December. There might be something vastly different about the timing of that business. So I usually like to look at 6-month comparative income statement or profit and loss statement, same thing, and then look at a year-to-date income statement versus the year-to-date in the same period in the prior year. So that's what we have today. Thanks so much for joining us again. As always, if you could hit the like and subscribe button so we can continue to deliver you tips on how to beat the odds at business. And if you have any questions that you'd like answering, feel free to leave them in the comments below, and we'll do our best to address them in a future video. Thanks very much.